I've spent most of my life around markets. And if there's one thing I've learned the hard way, it's this: trading feels hard because it is hard. Not because the charts are too complicated, not because the news moves too fast, but because the market has a way of pressing on the weakest parts of a man's mind. You can learn the rules. You can memorize patterns. But when real money is on the line, your nerves start talking louder than your reason. Have you noticed how calm your ideas feel when the market is closed, and how confused they become when the tape starts moving? Most traders think stress comes from losing money. That's only half the truth. The real strain comes from uncertainty. The market never tells you you're right when you enter a trade. It waits. It tests you. It moves just enough to make you doubt yourself. You buy a stock because the chart says it's ready, and the next tick goes against you. Nothing has changed, but everything feels different. Isn't it strange how one red bar can make a sound plan feel foolish? I learned early that the market doesn't reward intelligence alone. Some of the smartest men I ever met couldn't trade their way out of a paper bag. Why? Because they needed to be right. They argued with the tape. They explained away losses. Stress crept in because they were fighting reality instead of reading it. The market doesn't care about your opinion, and it certainly doesn't care about your comfort. Once you accept that, some of the pressure begins to lift. Have you ever asked yourself whether you're trading the market or trying to prove something to it? Chart reading looks mechanical on paper. Lines, levels, volume, time. But the stress enters when you must act. The chart gives you a signal, and suddenly you're alone with a decision. No committee, no certainty. Just you and the risk. That moment is where most traders break. They hesitate, they chase, or they exit too soon. Later they blame the system. But deep down, they know the trouble wasn't the chart. It was the inability to sit still while the market did what markets do. Stress trading often comes from wanting too much, too fast. A man who needs the market to pay his bills this week will feel every tick like a personal insult. He watches every fluctuation. He feels every pullback as danger. That kind of pressure clouds judgment. I always believed that the market pays best when you don't need it desperately. Capital that must survive gives you patience. Capital that is rushed makes you reckless. Ask yourself honestly, are you trading to build or trading because you feel cornered? There's another source of stress traders rarely admit. It's inconsistency. One day you follow your rules. The next day you bend them. You win once by breaking discipline, and now your mind is confused. Was it skill, or was it luck? The next time, you hesitate. Stress loves inconsistency. A simple method followed faithfully brings more peace than a brilliant one applied at random. Have you noticed how confidence grows not from winning, but from knowing exactly what you will do next? Many traders stare at charts all day, thinking more screen time will bring clarity. It often does the opposite. The more you watch, the more noise you see. Every small move starts to look important. Stress builds because your mind is trying to process what doesn't matter. I learned to wait for my moment. I let the market come to me. There is no prize for constant action. The big money is made by sitting, not by trading. Can you remember the last time doing nothing was the hardest part of your day? Money mindset in trading isn't about greed or fear alone. It's about respect. Respect for risk, respect for time, respect for your own limits. A man who risks too much on one trade will feel stress before the trade even starts. He will watch it breathe, panic at normal reactions, and exit at the worst time. Proper position sizing is quiet confidence. It allows you to think clearly. Isn't it easier to read the chart when you're not worried about survival? Stress also comes from misunderstanding losses. Losses are not personal failures. They are business expenses. The market charges rent for participation. When a trader treats every loss as an attack on his intelligence, he tightens up. He stops seeing opportunities. But when losses are accepted calmly and quickly, the mind stays open. The tape keeps talking, and you're still listening. Ask yourself this: do your losses teach you, or do they haunt you? Wealth building through trading is slow and uneven. That truth alone drives many men away. They want smooth progress, steady praise, constant reinforcement. The market offers none of that. It offers long periods of boredom, followed by moments of clarity. Stress arises when expectations don't match reality. A trader who expects excitement will overtrade. A trader who expects difficulty will be prepared. Which expectation are you bringing to the screen each day? I've always said the market is a mirror. It reflects discipline back to you, or it reflects chaos. When you feel stressed, it's often the market showing you something about yourself. Maybe you're trading too large. Maybe you're trading too often. Maybe you're trading without a real edge. The chart isn't just price, it's feedback. Are you listening to what it's telling you, or just reacting to how it makes you feel? The hardest lesson for me was learning that comfort is not the goal. Clarity is. Stress fades when decisions are planned in advance and executed without argument. You decide where to enter, where to exit, and how much to risk before the trade begins. After that, there's nothing to do but observe. When you find yourself stressed, it's often because you're improvising with real money. And improvisation in the market is expensive. Trading feels hard because it forces honesty. The chart doesn't flatter you. It doesn't negotiate. It doesn't explain itself. It just moves. And every move asks you the same quiet question: will you follow your rules today, or will you follow your emotions? That question is where the real pressure begins. The market pressures patience more than it tests intelligence. I learned that lesson long before I ever learned how to read a balance sheet or draw a clean line on a chart. You can be sharp, quick, well-read, and still lose money day after day if you can't wait. Intelligence helps you understand what might happen, but patience is what allows you to be present when it actually does. Have you noticed how often you know the right trade, yet still manage to take the wrong one? Most men come to trading believing the challenge is mental calculation. They think if they study enough patterns, enough indicators, enough history, they'll outthink the market. But the market isn't a puzzle to be solved. It's a stream to be crossed. You don't cross it by rushing. You cross it by waiting for the right moment, the solid footing, the clear path. Impatient traders jump in midstream and wonder why the current takes them under. Isn't it curious how the hardest part isn't knowing what to do, but waiting to do it? Charts don't demand brilliance. They demand restraint. A clean setup may take days, sometimes weeks, to develop. During that time, price moves around, shaking weak hands, tempting action. The impatient trader feels this movement as pressure. He tells himself he's being proactive, when in truth he's just uncomfortable sitting still. Patience feels passive to the ego, but in trading, passivity is often preparation. Ask yourself honestly, how many trades did you take just to relieve the discomfort of waiting? The market has a way of humiliating the clever man who lacks patience. He sees a pattern early and enters too soon. The idea is right, but the timing is wrong. The stock moves against him, not because the analysis was faulty, but because the market wasn't ready. He exits in frustration, only to watch the move unfold exactly as he first imagined. That kind of experience doesn't wound the wallet as much as it wounds pride. And wounded pride is where stress grows roots. Patience also means accepting dullness. Most trading days are unremarkable. Nothing lines up. Volume is thin, trends are unclear. The intelligent mind wants stimulation. It wants engagement. The patient trader accepts boredom as part of the job. He knows that forcing action during quiet conditions leads to small losses that add up. Can you sit through a slow day without convincing yourself you're missing something? When patience is absent, intelligence becomes dangerous. A smart trader can justify almost any trade. He can explain why the rules don't apply this time. He can talk himself into early entries, oversized positions, unnecessary risk. Patience acts as a filter. It stops you from acting on every clever thought. It asks one simple question: is the market confirming this idea, or am I trying to force it? Time is the market's favorite weapon. It stretches moves just long enough to exhaust impatience. Breakouts hesitate. Trends pause. Pullbacks linger. The impatient trader reads hesitation as failure. He exits right before resolution. The patient trader understands that time is part of the pattern. A stock doesn't move because you want it to. It moves when supply and demand are ready. Do you trust the process enough to let time do its work? Wealth in trading comes from catching sustained moves, not constant activity. Sustained moves require waiting through discomfort. They require holding while nothing seems to happen. That's where patience pays its highest dividends. Anyone can buy a breakout. Few can hold it through the first pullback without flinching. Intelligence spots opportunity. Patience captures it. Without patience, profits remain theoretical. Stress often enters when a trader mistakes waiting for weakness. He feels unproductive, behind, left out. He compares himself to others who seem constantly active. But activity is not progress. The market doesn't reward effort, it rewards timing. The patient trader is selective. He trades less, but better. His stress is lower because his decisions are deliberate, not reactive. Have you ever noticed how calm the best trades feel before you enter them? Patience is also closely tied to money management. A trader who waits for proper setups doesn't need to risk much. The odds are clearer. The invalidation point is obvious. Impatience leads to guessing, and guessing requires larger risk to feel worthwhile. Larger risk amplifies stress. The cycle feeds itself. Patience breaks that cycle by narrowing focus and reducing exposure. The market will never rush to accommodate you. It doesn't care if you're ready today or desperate this week. It moves on its own schedule. Accepting that reality removes a great deal of tension. Once you stop trying to speed the market up, you stop feeling chased by it. You begin to observe instead of pursue. Patience isn't inactivity. It's controlled readiness. It's knowing exactly what you're waiting for and refusing everything else. That discipline sharpens judgment and quiets emotion. And when the moment finally comes, the action feels almost easy. That waiting is where most traders struggle. Needing fast results makes normal price movement feel dangerous. That truth reveals itself the moment a trader watches a position tick against him and feels his chest tighten. Nothing unusual is happening on the chart. Price is doing what price has always done, advancing, reacting, pausing. Yet to the trader who needs the trade to work quickly, every pause feels like a warning and every pullback feels like a threat. Have you ever noticed how calm a chart looks when you don't have money on the line, and how hostile it appears the moment you do? The market was never designed to move on your schedule. It doesn't respond to deadlines, bills, or expectations. But the trader who needs immediate results trades as if it should. He enters with a clock running in his head. Every bar that doesn't confirm his hope feels like wasted time. This urgency distorts perception. Normal fluctuations begin to look like reversals. Healthy consolidations look like failure. The chart hasn't changed, but the lens through which it's viewed has. When a trader depends on fast results, patience disappears before the trade even begins. He buys a breakout and expects instant follow-through. When it hesitates, doubt creeps in. He watches every tick, searching for reassurance. The more he watches, the more reasons he finds to worry. The mind fills the silence with fear. Isn't it curious how the market feels most dangerous when you're watching it too closely? Fast expectations create fragile conviction. The trader enters without truly accepting the risk. He tells himself where the stop is, but emotionally he's already rejected the possibility of being wrong. So when price moves against him, even slightly, it feels unacceptable. Stress comes not from the loss, but from the surprise. The market is behaving normally, yet the trader feels betrayed because reality didn't match urgency. Charts breathe. They expand and contract. They test levels, shake hands, and retest them again. This is not noise, it's structure. But the trader who needs speed sees structure as delay. He exits early, often right before the move begins. Later he calls it bad luck. In truth, it was impatience dressed up as caution. Have you ever sold a position for peace of mind, only to watch it move exactly as planned once you were gone? The desire for fast results often comes from outside the market. Financial pressure, comparison, ego. A man who needs the market to perform quickly is not trading freely. He is negotiating with fear. That fear tightens decision-making. It leads to early exits, late entries, and oversized positions meant to make it worth it. Each of those choices increases stress, not opportunity. Normal price movement includes pullbacks. It includes pauses. It includes false starts. These are not signs of danger, they are the cost of participation. but urgency reframes them as threats. The trader begins managing emotion instead of risk. He moves stops closer, takes profits too soon, and re-enters worse than before. The chart hasn't become harder, the trader has become impatient. Needing speed also encourages overtrading. If one trade doesn't work quickly, another must. The trader jumps from setup to setup, never allowing any idea time to mature. Losses accumulate, not because the ideas were poor, but because none were allowed to develop. Stress compounds as attention fragments. The trader feels busy yet unproductive. Isn't that one of the most exhausting states a man can be in? Markets reward those who allow trades to unfold naturally. Time is an ingredient, not an obstacle. The trader who understands this measures success, not by immediate profit, but by quality of execution. He knows that a trade going sideways is not a personal failure. It's simply the market gathering information. When you remove the demand for speed, price movement regains its neutrality. Fast expectations also distort position sizing. When a trader wants quick results, he often risks more than the setup deserves. He needs the outcome to matter. That added size magnifies every fluctuation. A 1-point move feels like a verdict. Stress spikes not because the market is volatile, but because the position is too large for patience to survive. Would that same move bother you if the size was smaller? Wealth building through trading has never been about speed. It's about alignment. Alignment between market conditions and trader temperament. When that alignment is off, even good trades feel painful. The market can move in your direction and still feel stressful if it doesn't move fast enough. That kind of tension drains clarity. It leads to mistakes that have nothing to do with charts and everything to do with expectation. The trader who releases the need for fast results regains perspective. He sees pullbacks as opportunities to observe, not emergencies to escape. He allows trades room to breathe. Stress decreases because nothing urgent is required. Decisions become cleaner. Risk becomes manageable. The market feels less like an adversary and more like a process. Impatience turns time into an enemy. Patience turns time into an ally. That difference changes how every bar feels. Proper position size is the trader's first stress control. I learned that long before I learned anything fancy about patterns or trends. A man can have the best setup in the world and still be too tense to execute it properly if he's carrying too much size. The moment your position is larger than your comfort, the chart stops being information and starts being a threat. Have you ever noticed how a trade feels completely different when the size is small enough to let you think? Most traders believe stress comes from uncertainty in the market, but more often it comes from certainty about risk. Deep down, they know they're risking too much. They feel it the moment they click the button. That feeling doesn't disappear once the trade is on. It follows every tick, every pause, every retracement. Even normal price movement becomes unbearable when the position is oversized. The market hasn't changed, but your ability to tolerate it has. Position size decides how clearly you can read a chart. When size is too large, your eyes stop seeing structure and start hunting for relief. You're no longer analyzing, you're hoping. Support levels become prayers. Resistance becomes fear. Every bar carries emotional weight. But when the size is appropriate, price can move naturally without disturbing your judgment. Isn't it easier to be objective when the outcome doesn't feel like a verdict on your future? Many traders obsess over entries and exits while ignoring size, as if it were a minor detail. It isn't. Size turns ideas into reality. A small mistake with big size hurts more than a big mistake with small size. Proper sizing forgives timing errors. It allows room for noise. It gives the trade space to work. Without it, even correct analysis becomes useless because the trader cannot sit through the process. Stress in trading often masquerades as vigilance. A trader with too much size tells himself he's being disciplined by watching closely. In truth, he's trapped. He can't look away because the position is emotionally unsafe. His mind is tied to every fluctuation. That kind of attention is exhausting. Proper size creates distance. Distance restores calm. Calm restores judgment. There's a direct relationship between size and patience. The larger the position, the less time a trader can tolerate uncertainty. He needs confirmation quickly. He needs progress immediately. That demand pressures the trade and shortens its lifespan. Proper size removes urgency. It allows the trader to let the market unfold on its own schedule. Have you ever wondered why some traders seem so relaxed while others are constantly tense, even when trading the same setup? Position sizing is also a form of self-knowledge. It forces you to be honest about your tolerance for loss. Not theoretical tolerance, but real tolerance. What can you lose and still think clearly? What amount lets you sleep without checking the market? Many traders answer these questions with ego instead of honesty. They size based on what they want to make, not on what they can afford to lose. Stress begins right there. A properly sized trade accepts the possibility of loss from the start. That acceptance frees the mind. There's no internal argument when price moves against you. You knew it could happen. You planned for it. Stress fades when surprise disappears. Losses become manageable events instead of emotional shocks. Oversizing also leads to premature exits. The trader can't stand normal drawdowns, so he exits early, often at the worst moment. Later, he watches the trade work without him. That experience breeds frustration and self-doubt. He tells himself the market is cruel, when in reality it was his size that made patience impossible. Would you have stayed in that trade if the size were half as large? Proper position size aligns risk with process. It shifts focus from outcome to execution. When the risk is right, the trader can ask better questions. Is the trend intact? Is the level holding? Is volume confirming? When risk is wrong, there's only one question: how do I get out without pain? Wealth building in trading depends more on survival than brilliance. A trader who controls size survives long enough to let skill compound. Stress drains capital in quiet ways. It leads to mistakes, revenge trades, hesitation. Proper sizing acts as a buffer against those errors. It doesn't eliminate stress entirely, but it keeps it within tolerable limits. The market will always move in ways you can't control. Size is one of the few things you can. That makes it powerful. Ignore it, and the market feels wild and hostile. Respect it, and the same market feels manageable. Everything begins with size. That's where calm starts. Losses become stressful only when taken personally. I learned that lesson after enough losses to know the difference between pain and damage. The market will take money from you sooner or later. That part is unavoidable. What decides whether a loss turns into stress is the story you attach to it. When a trader treats a losing trade as evidence of personal failure, the loss lingers far longer than it should. Have you ever noticed how one small loss can ruin your focus for the rest of the day if you let it mean too much? The market doesn't know who you are. It doesn't know how hard you studied, how confident you felt, or how badly you wanted the trade to work. Price moves because of supply and demand, not because of your intentions. But the moment a trader forgets that, every loss feels like a judgment. He stops seeing it as a cost of doing business and starts seeing it as an insult. Stress grows in that gap between reality and interpretation. A planned loss is not a mistake. It's a decision fulfilled. Yet many traders enter a trade hoping they won't have to accept the decision. They place a stop, but emotionally they don't believe they'll need it. So when price hits that level, shock sets in. The mind scrambles for explanations. The market is manipulated. I got unlucky. I should have waited. The loss becomes personal because it wasn't accepted beforehand. Isn't it easier to handle an outcome you already agreed to? When losses are taken personally, they contaminate the next decision. The trader hesitates, second, guesses, or overcompensates. He trades smaller than he should, or larger out of frustration. His focus shifts from reading the chart to repairing his confidence. That's when stress multiplies. One loss turns into a string, not because the edge disappeared, but because emotional balance did. The professional view of losses is unemotional. That doesn't mean indifferent. It means objective. A loss is information. It tells you the setup failed, the timing was off, or the conditions changed. It doesn't say anything about your worth or intelligence, but ego doesn't like neutrality. Ego wants praise when right and excuses when wrong. Trading punishes ego because it demands consistency, not validation. Many traders say they accept losses, but their behavior says otherwise. They widen stops to avoid being wrong. They remove stops entirely. They hold and hope. All of that is driven by the need to avoid the emotional discomfort of admitting a mistake. Stress doesn't come from the loss itself. It comes from resisting it. The longer you fight a loss, the heavier it becomes. Losses also feel personal when traders identify too strongly with individual trades. They speak in terms of my trade and my idea. That attachment makes letting go difficult. The market doesn't care whose idea it was. It only cares whether it works. A trader who can detach from individual outcomes remains flexible. A trader who can't becomes rigid and stressed. There's a strange relief that comes from accepting losses as routine. When you expect them, they lose their power to surprise you. You stop flinching. You stop reacting. You exit when your plan says to exit and move on. Stress thrives on resistance. Acceptance starves it. The longer a trader stays in the game, the more losses he accumulates. That's not pessimism, that's arithmetic. The difference between a stressed trader and a calm one is not the number of losses, but the meaning assigned to them. One sees losses as tuition, the other sees them as proof he doesn't belong. Which meaning helps you stay clear-headed. Losses become especially stressful when tied to self-image. A trader wants to see himself as disciplined, skilled, insightful. A losing trade threatens that image. Instead of adjusting behavior, he defends identity. He argues with the chart. He blames conditions. Stress increases because reality is no longer allowed to be what it is. Chart reading requires openness. You must be willing to change your mind when price changes its story. That flexibility disappears when losses feel personal. The trader becomes stubborn. He wants the market to validate him. Markets never do. They only move. Wealth building demands a long view. No single trade matters much in that context. But a trader who personalizes losses shrinks his time horizon. Every trade becomes a referendum. That pressure makes trading feel heavier than it needs to be. Remove the personal element, and trading becomes procedural again. A loss handled properly ends the moment it's taken. A loss handled emotionally drags on. That difference shapes everything that follows.